Hello, my name is Joe Hoyle, and I'm one of the co-authors of your financial accounting textbook. And today I want to talk with you for a few minutes about double entry bookkeeping. This is the system that was invented hundreds of years ago in Italy to help business people maintain what was happening in their business, to keep a record of their financial transactions so that they had some way to show whether they were a success or a failure. It was often used in shipping, where the owners of the boat would keep up with what they had spent and what they had received as a way to show what profit was actually made. If this system has been used for 500 years, then there's absolutely no reason why you can't learn it yourself. It's a fairly mechanical little system, and it uses a lot of the terminology that you hear in financial accounting. So I want to make sure that you see how to do the basics of double entry bookkeeping and then be able to use it to record transactions and events that happen every day in a business organization. Normally, we begin double entry bookkeeping with a journal entry. And the journal entry is going to be a record of a financial effect of a transaction, so that if you buy a building, you need a record of what happens. If you sell inventory, you need a record of what happens. The purpose of the journal entry is to record the events that happen in a transaction. The second step is the use of T accounts. And the T accounts are simply a way to keep up with account balances. Journal entries keep up with the effect of transactions. T accounts keep up with the balance of each account. So for example, you might have a T account for cash, or you might have a T account for rent expense. And this is where you would keep up with those balances. How much cash do you have? How much rent expense have you incurred? These are T accounts. Now, the key to double entry bookkeeping is that the left side of this T account is referred to as a debit. So anytime you're looking at the left side of a T account, that has been known for hundreds of years as the debit side. The right side is known as the credit side. For some accounts, you increase them on the debit side. For other accounts, you increase them on the credit side. Now, that might seem rather confusing, but it's only confusing the first time or two that you see it. With a little practice, this becomes fairly easy. I have taught accounting for decades. I have taught double entry bookkeeping to thousands of students. They have to practice a little bit, but if they're willing to do the practice, I've never had a single student who didn't learn how to make debits and credits in a proper fashion. So let's see how to do that. That's what your goal is to see how to use this double entry system of debits and credits to record the financial effect of transactions. So here is kind of the key to the whole process. You're trying to reflect increases and decreases. Now, 500 years ago, what you were worried about was increases and decreases in cash. Where do we get our cash? What do we do with the cash? Well, over time, businesses have become much more complicated. So now we're more interested in increases and decreases in net assets. But for simplicity's sake, you can simply think of it as cash. What causes an increase in cash? What causes a decrease in cash? So first, we're going to look at the debit accounts, what I refer to as the debit accounts. These increase if they are a use of either cash or net assets. I'll repeat that. You use a debit account if it's a use that increases in your accounts. So how do you use cash? Typically, you use cash or net assets in three ways. You have expenses. Therefore, an expense would increase with a debit. expense is a use of assets. It is a use of cash. So therefore, it will increase with a debit. You can buy another asset, such as land or building or inventory or prepaid rent. That is a use of your cash. So therefore, an increase in an asset will also be shown as a debit. Finally, you can have a dividend distribution. You can give the money back to the owners of the business. That's a use of your cash. You can use cash for expenses. You can use cash for assets. You can use cash for dividend distribution. So if you have any one of those three accounts and you want to increase either an expense or an asset or a dividend distribution, 500 years ago, a mark would have been made on the debit side. Today, that same amount would be put on the debit side. The system still works in that way. Now, that's only three accounts. Now, remember, we'll also have losses, which are somewhat like expenses, so they kind of go together. But if I ask you, if you're in my class and I say, what increases with a debit? It's a use of assets. Expenses, assets, you buy another asset, or dividend distribution. That's only three accounts that increase with a debit. You can learn that. Now, there are also some accounts that increase with a credit, that show this increase with a credit. They are accounts that are sources of your cash or your net assets. If you're in business, where do you get your net assets? Well, you get your net assets in three ways. You can get them from revenues or gains if it's not from your primary business operation. You can get them from borrowing money. You can get them from liabilities, or you can get them from your owners, the capital stock. There's only really three ways to increase your net assets, your cash, if you will. And that is, you can sell something, you have revenue. You can borrow something, you can have a liability, or you can get money from the owners, you can have capital stock or contributed capital. So anytime you look at one of these three accounts and they have some amount over here in the credit side, that tells you that that is an increase. And so there's only 6 accounts. You could sit down in 5 minutes and simply memorize this. It will help if you practice, but it's only 6 types of accounts. How do you increase accounts with a debit? You increase accounts with a debit if they're expenses, assets, or dividend distributions. What accounts do you increase with a credit? You increase revenues, liabilities, and capital stock or contributed capital with credits because they're sources of your cash or your net assets. Now, there's one account, retained earnings, that really can be either one. Retained earnings keeps up with all the income since you first began the business, less all of the dividend distributions. If the revenues are higher than the expenses and the dividends, then this will have a credit balance. It will follow the example of the revenues. On the other hand, if the revenues are less than the expenses and dividends, then it will have a debit balance because it will follow the example of the expenses and the dividends. I cannot tell you, as far as just double entry bookkeeping, how important this current page is. If you simply sit down and you go through this a couple of times, you will be able to say, yeah, I can do double entry bookkeeping as well as anyone could for the last 500 years. Debits show an increase in expenses, assets, and dividends. Credits show an increase in revenues, liabilities, and capital stock. That's the key to working with double entry bookkeeping. And that's what we're going to practice here, is we're going to make sure that you understand how to do that. So what I'd like to do is to record some basic transactions in journal entries. We've got 6 here. If you practice enough to do these 6, you should be in fine fashion as far as doing debits and credits. So let me read them real quickly. Notice there's nothing odd here. These are just basic standard transactions. Company issues capital stock to its owners for $38,000 cash. What goes up? What goes down? How do you convert that into debits and credits? Company buys inventory for $20,000 on account. Company sells 70% of that inventory for $23,000. Notice that they didn't sell all $20,000. They only sold $14,000 because they sold 70%. Company pays its employees $12,000 for work done last year. So this is something that they did in the past. The accrued expense, and we've talked about accrued expenses before, was recorded at that earlier time. You had to know this for an accrued expense before you could do the journal entry. Number 5, the company collects $5,000 from the customers who bought the inventory above. So when they bought the inventory, they didn't pay anything. But in number 5, they're paying $5,000. And finally, number 6, you pay $4,000 for last month's rent. This is again going back into the past. It's an accrued expense and it was not recorded. Notice in 4, it is recorded, and in 6, it's not recorded. I wanted to do both sides or both possibilities just to give you a practice on doing them both ways that we have previously looked at. Now we're going to do these 6, maybe once or twice. And once you do that, I think you'll start feeling comfortable with double entry bookkeeping. Company, we'll go to the first one. Company issues capital stock for $38,000 in cash. The first time you do this, think about it in terms of what goes up and what goes down. Here, cash goes up by $38,000, and the capital stock or the contributed capital account also goes up by $38,000. That's just a fact. That's what happened. That doesn't take magic. Cash goes up, capital stock goes up. That's what happens. Cash is an asset. An asset increases with a debit. So you make a cash entry here of $38,000 as a debit. Capital stock is a source of this asset. So therefore, it will go up as a credit. This is how a company would take the transaction, would analyze that transaction, and then would record that transaction here in what we refer to as a journal entry. That was the way it was done for the last hundreds of years all around the world in some places. So therefore, you should be able to learn how to do this. Notice that clearly the cash is on the left side. The number is on the left side. That means it's a debit. The capital stock is on the right side between the two accounts, and the money or the number is on the right side. It's very clear that this is the debit. Don't leave it to imagination. Make sure that both the title and the number on the left side, this is on the right side. That's the credit, therefore. So that's your very first journal entry. They get a little harder than that, but really, to tell you the truth, not much harder than that once you've practiced on them for a while. Number 2, the company buys inventory for $20,000. They don't pay cash. They buy it on account. Always begin by saying what goes up and what goes down. Inventory goes up $20,000. Does that make sense? Oh, sure it does. Accounts payable goes up $20,000. And again, does that make sense? Well, I think so. Inventory went up, accounts payable went up. Once you can do the ups or the downs, then you can make the journal entry. Inventory is an asset. Assets increase with a debit. There it is. Accounts payable is a liability, a source of cash or assets. Once it goes up, that's a credit. So your inventory is recorded as a debit, which means it went up. Accounts payable is recorded as a credit. And since it's a liability, that tells you also that it went up. That's the system that companies base their accounting records off of when they are keeping up with all of their various transactions that they're having to record. Our third transaction, they're going to sell some of this inventory. They only sell 70%, but they sell it for $23,000 and they sell it on account. Notice here, I'm thinking my way through what happened. They sold 70%, on account for $23,000. Now we're going to do something new here. This is the sale of inventory. When you sell inventory, we're going to record two things, not one. First, we're going to record the actual sale. Then we're going to record the transfer of the inventory to the customer. Now, in a later chapter, we will learn an alternative for this. But here today in this early chapter, this is fine. They made a sale, you record that, and then they transferred the inventory to the customer, so you record that also. Let's do the sale first. Accounts receivable go up by $23,000. That's an asset. That's recorded as a debit. Sales revenue go up. Revenue is a source of your net assets. It goes up with a credit balance, and so that shows that. If an accountant looks at this, the accountant would say, okay, accounts receivable is debited. That means it went up. Sales revenue is credited. That means that it went up also. You learn to read these things. Now notice, we only recorded here the revenue. Now you might ask, we didn't get any cash. Can I record that revenue if there is no cash being recorded? And the answer is, as long as the seller, the company, has done all of the performance obligations that were required, then yes, you can record, or you have to record the revenue. That's always the key rule in US GAAP for revenue recognition. You recognize revenue when the performance obligation has been fulfilled. They were selling the inventory. They gave the inventory to the customer. Therefore, they should recognize the revenue here at that point. But keep in mind, this is only the first half of this transaction. We still have to record the transfer of the inventory to the customer. So we make a second entry for this transaction, and cost of goods sold, which is the expense that we use whenever inventory is removed from the company because it's given or sold to a customer. That expense is known as cost of goods sold, and that went up $14,000, 70% of the $20,000. Inventory goes down $14,000. The cost of goods sold is an expense. An expense shows an increase as a debit. Inventory is an asset. An asset increases with a debit, but here it's a decrease. So we record that as $14,000. It's not an increase. It's not a debit. It's a decrease. Now, I want to stop right there and mention two things that you probably already have noticed. One is that in every account, you always have at least two accounts involved. Now, you could have 3 or 4 or 5 or whatever, but you have to have at least two. And the reason is there's always a cause and an effect. The inventory went down because it was expensed and given to the customer. So you have to record both the cost of goods sold and the reduction to the inventory. So there always has to be 2 or more accounts, always. No matter how much accounting you take, there will always be at least 2 accounts. The second thing I want to draw your attention to is that the debits always equal the credits for every transaction. And the reason is that there's always an equal and opposite effect. The cost of goods sold caused the inventory to go down. So if the cost of goods sold was $14,000, then the inventory reduction also had to be $14,000. There's always going to be 2 accounts, and the debits are always going to equal the credits. You can study accounting for the next 25 years, and those 2 rules will always be there. Okay, we're still practicing. We're just trying to make sure you see how to do various transactions. These are just standard transaction. The company pays the employees $12,000 for work done last year. So you know that means there had to have been an expense. However, this accrued expense was recorded at that time. So the expense has already been recorded. What the company would have done because of that sentence there, the company would have recorded the expense for $12,000 and recorded the payable or the liability for $12,000. That's already been recorded. How do I know? Heck, the problem tells me that. The problem tells me it was recorded. So once we record the payment, we do not record the expense because we've already recorded the expense. All we do is get rid of the liability. We pay off the liability. That's what this problem is about. They're paying off the liability. The salary payable goes down. Salary payable is a liability. It goes up with a credit. It will go down with a debit. Cash also goes down. Cash is an asset. It goes up with a debit. It will go down with a credit. And that's exactly what I'm showing here. Salary payable is debited. That tells the reader that it has gone down. They have paid that balance right there off. And my cash has also go down. So that is shown by that entry. Remember, expenses, assets, and dividend distributions increase with a debit, so they will decrease with a credit. Revenues, liabilities, and capital stock increase with credits, so they will go down with debits. Yes, I know the first time you hear it, you'll say that's a terribly tricky puzzle. It's only going to be tricky for a couple of days. After my students have practiced this a couple of times, this is the easiest part of the course, but they've got to practice. If you don't practice, it will get away from you pretty quickly. Now, customers come in and they pay us $5,000. Remember, we made the sale earlier and we recorded the sale earlier when the performance obligation was fulfilled. They're coming in to make the payment. Cash goes up $5,000. This transaction analysis, the ups and downs, as I often say, gets to where you understand what happened. And accounts receivable goes down. It's not a revenue because you've already recorded the revenue when the performance obligation was fulfilled. So cash is an asset. It goes up. It goes up with a debit. Accounts receivable is also an asset, but this time it's going to go down. So it goes down with a credit. And by now, we have started getting used to almost all of the basic transactions. If you can come up with, oh, I don't know, 15 or 20 transactions and learn to do all 15 or 20, you can probably do any that anybody can do, to tell you the truth. I'm just using 6 here to get you started. And for our last transaction, they paid last month's rent of $4,000, again, an accrued expense that grew up over time. But the company has chosen in this case not to report that. So is there a rent expense on the books already? No. No rent expense has ever been reported. Is there a rent payable on the books? No, it's not been recorded. That's what that not tells us. So far, there's no rent expense and there's no rent payable. So what happens then? Well, since the rent expense has not been recorded, it should go up by $4,000. The cash is being paid, so it will go down by $4,000. That's what actually took place. Rent expense, of course, is an expense. Expenses increase with debits. Cash is an asset. It is going down. Assets decrease with a credit. That's the journal entry we have for that case. These are great examples. If I were you, and I hope you will, watch the video once or twice, stop the video, make the journal entry, and then see how I handle each one. When you get where you can do these 6 without too much trouble, then you've got a strong foundation of knowledge about double entry bookkeeping. I want to finish off by just kind of putting this together. there is a transaction. For example, you collect $5,000 from customers. It has to be recorded in some way. So it's recorded in a journal entry using a system of debits and credits. What goes up, what goes down, that system is how you find out or how you tell a record of all financial events. The journal entry, which is in the company's journal. Each of those debits and each of those credits then are recorded in the appropriate T account. So if you have an entry where you debit cash for $5,000 and you credit accounts receivable for $5,000, then this debit to cash is moved to the cash T account. And this credit to accounts receivable is moved to the account receivable T account. So keep in mind, the journal entries record the transactions, the events of the transactions. Each debit and each credit is moved to the appropriate T account where the account balances are maintained. And the T accounts are kept in what's called a general ledger. The journal entries record the transactions. The T accounts in the ledger record the account balances. And that's the system that we have used for many, many, many years. Now, you may eventually have to adjust those accounts a little bit more because time will change them, or maybe there's an error in there. But if there's no adjustments needed and there's been no errors made, then the T account balances are simply used to prepare the financial statements. So if you have a T account for cash and that T account for cash shows that you've got $17, then when you make your balance sheet and you report your current assets, then you would report cash of $17,000. The T account balance, after it's been adjusted for time and errors, is the balance that's actually reported in the financial statements. That's the system that companies use to keep up with all of their thousands and maybe millions of transactions and account balances so that they can come up with presented fairly financial statements that decision makers like you can use to make wise business decisions. My name is Joe Hoyle. I'm one of the co-authors of your financial accounting textbook. It's a pleasure working with you. I know debits and credits can seem rather odd, I guess, but if you practice with them just a little bit, there's only 6 accounts: expenses, assets, dividend distributions. They increase with debits, revenues, liabilities, capital stock. They increase with credits. That is the foundation system. You can do that. Trust me, you can do that.